Critical Man Pictures presents the Forex video training series. Black Belt, First Degree, Carry Trades. Do you know there is a trading system that can make money if price stayed exactly the same for long periods of time? Well, there is, and it's one of the most popular ways of making money by many of the biggest and baddest money manager mamma-jammas in the financial universe. It's called the carry trade. The carry trade involves borrowing or selling a financial instrument with low interest rate, then using it to purchase a financial instrument with a higher interest rate. When you are paying the low interest rate on a financial instrument you borrow sold, you are collecting higher interest on the financial instrument you purchased. Thus, your profit is the money you collect from the interest rate differential. For example, let's say you go into a bank and borrow $10,000. Their lending fee is 1% of that $10,000 every year. With that borrowed money, you turn around and purchase a $10,000 bond that pays 5% per year. And what's your profit? You got it, 4% a year, the difference between the interest rates. And now you're probably thinking, that doesn't sound as exciting or profitable as catching swings in the market. However, when you apply it to the spot Forex market with its higher leverage daily interest payments, sit back and watch your account grow daily can get pretty sexy. To give you an idea, a 3% interest rate differential becomes 60% annual interest a year on an account that is leveraged 20 times. In this section, we will discuss how carry trades work, when they will not work. We'll also tackle risk aversion. In the Forex market, currencies are traded in pairs. For example, you buy Euro Swissy. You are actually buying the euro and selling Swiss francs at the same time. Just like in the previous example, you pay interest on the currency position you sell, and you collect interest on the currency position you buy. What makes the carry trade special in the spot Forex market is that the interest rates payments happen every trading day based on your position. Technically, all positions are closed at the end of the day in the spot Forex market. You just don't see it happen if you hold a position into the next day. Brokers close and reopen your position, and they debit credit your overnight interest rate difference between the two currencies. This is the cost of carrying, also known as rolling over a position to the next day. The amount of leverage available from Forex brokers has made the carry trade very popular in the spot Forex market. Most Forex trading is margin-based, meaning you only have to put up a small amount of your position, and your broker will put up the rest. Many brokers ask as little as 1 to 2% of a position. What a deal! Let's take a look at a generic example to see how awesome this can be. For this example, we'll take a look at Joe, the newbie Forex trader. It's his birthday, and his grandparents, being the sweet and generous people they are, gave him $10,000. Sweet! Instead of going out and blowing his birthday present on video games and posters, he decides to save for a rainy day. Joe goes to a local bank to open up a savings account, and the bank manager tells him, Joe, your savings account will pay 1% a year on an account balance. Isn't that fantastic? Joe pauses and thinks to himself, at 1%, my $10,000 will only earn me $100 in a year. Damn, that sucks. So, Joe kindly responds to the bank manager, thank you, sir. I think I'll invest my money somewhere else. Joe has been demo trading several systems, including the carry trade, for over a year, so he has a pretty good understanding of how Forex trading system works. He opens up a real account, deposits his $10,000 birthday gift, and puts his plan into action. Joe finds a currency pair whose interest rate differential is plus 5% a year, and he purchases $100,000 worth of that pair. Since his broker only requires a 1% deposit of the position, they hold $1,000 in margin, 100-to-1 leverage. So, Joe now controls $100,000 worth of a currency pair that is receiving 5% a year in interest. What will happen to Joe's account if he does nothing for a year? Well, there are 3 possibilities. Let's take a look at each one. Currency position loses value. The currency pair Joe buys drops like a rock. If the loss brings the account down to the amount set aside for margin, then the position is closed and all that's left in the account is the margin, $1,000. The pair ends at the same exchange rate at the end of the year. In this case, Joe did not gain or lose any position on his value on his position, but he collected 5% interest on the $100,000 position. This means on interest alone, he made $5,000 off his $10,000 account. That's a 50% gain. Sweet. Currency position gain value. Joe's pair shoots up like a rocket. Not only does Joe collect at least $5,000 in interest on his position, but he also takes home any gains. That would be a nice present to himself on his next birthday. Because of the 100-to-1 leverage, Joe has the potential to earn 50% a year from his initial $10,000. Here is an example of a currency pair that offers a 4.4% differential rate on interest rates September 2010. Long Australian dollar Japanese yen carry trade breakdown. If you buy the Aussie yen and hold it for a year, you earn a positive carry of 4.4%. If you sold Aussie yen and held it for a year, you would earn a negative carry of 4.4%. Again, this is just a generic example of how the carry trade works. Now, let's see, it's time to move on to the most important part of this lesson. Carry trade risk. Carry trades work best when investors feel risky and optimistic enough to buy high-yielding currencies and sell low-yielding currencies. It's kind of like an optimist who sees the glass as half full. When the current situation might not be ideal, he is hopeful things will get better. The same goes for the carry trade. Economic conditions may not be good, but the outlook for the buying currency does not need to be positive. If the outlook of a country's economy looks as good as Angelina Jolie, then chances are that the country's central bank will have to raise interest rates in order to control inflation. This is good for the carry trade because a higher interest rate means a bigger interest rate differential. On the other hand, if a country's economic prospects aren't looking too good, then no one will be prepared to take the currency if they think the central bank will have to lower interest rates to help the economy. To put it simple, carry trades work best when investors have low risk aversion. Carry trades do not work well when risk aversion is high, i.e. selling higher yielding currencies and buying back lower yielding currencies. When risk aversion is high, investors are less likely to take risky ventures. Let's put this into perspective. Let's say economic conditions are tough and the country is currently undergoing a recession. What do you think your next door neighbor will do with his money? Your next door neighbor will probably choose a low-paying yet safe investment and put it somewhere else. It doesn't matter what the return is as long as the investment is a sure thing. This makes sense because it allows your neighbor to have a fallback plan in the event things go bad, i.e. he loses his job. In Forex jargon, your neighbor is said to have a high level of risk aversion. The psychology of big investors isn't that much different from your next door neighbor. When economic conditions are uncertain, investors tend to put their investments in safe haven currencies that offer low interest rates, like US dollar and Japanese yen. This is the polar opposite of carry trade. The inflow of capital towards safe assets cause currencies with low interest rates to appreciate against those with higher interest. It's pretty simple to find a suitable pair to do a carry trade. Look for two things. Find a high interest rate differential. Find a pair that has been stable or in an uptrend in favor of the higher yielding currency. This gives you the stability to stay in the trade as long as possible and profit off the interest rate differential. Pretty simple? Let's take a look at a carry trade in action. This is a weekly chart of the Australian dollar Japanese yen. Up until recently, Bank of Japan has maintained a zero interest rate policy. As of September 2010, the interest rate stands at 0.10%, with the Reserve Bank of Australia touting one of the higher interest rates among the major currencies, currently at 4.5%. Many traders have flocked to this pair, one of the factors creating a nice little uptrend on the pair. From the start of 2009 to early 2010, this pair moved the price from 55.50 to 88. That's 3,250 pips. If you couple that with the interest payments from the interest rate differential of the two currencies, this pair has been a nice term play for the many investors and traders we're able to weather the volatile up and down movements of the currency market. Of course, economic and political factors are changing the world daily. Interest rates and interest rate differentials between currencies may change as well, bringing popular carry trades, such as the yen carry trade, out of favor with investors. Because you're a very smart trader, you already know the first question you should ask before entering a carry trade. What is my risk? Correct. Before entering a trade, you must always assess your max risk and whether or not it is acceptable according to your risk management rules. In the example at the start of the lesson with Joe the newbie Forex trader, his maximum risk would have been $9,000. His position would have automatically be closed out once his losses hit $9,000. That doesn't sound very good. Remember, this is the worst case possible scenario, and Joe is a newbie, so he doesn't fully appreciate the value of stop losses. When doing a carry trade, you can still limit your losses just like a regular directional trade. For instance, if Joe decided that he wanted to limit his risk to $1,000, he could set a stop order to close his position whenever the price would have been a $1,000 loss. He would still keep any interest payments he received while holding on to his position. When you are paying a low interest rate on the financial instrument you borrowed, sold, you're collecting a higher interest rate on the financial instrument you purchased. Your profit is the money you collect from the interest rate differential. There is another way to make money in the Forex market without having to buy low and sell high, which can be pretty tough to do day after day after day. Carry trades work best when the investors feel like taking on risk. Current economic conditions need not be good, but the outlook does need to be positive. If a country's economic perspectives aren't looking too good, then nobody will prepare to take on the risk. To put it simply, carry trades work best when investors have low risk aversion. Carry trades do not work well when risk aversion is high. When risk aversion is high, investors are less likely to buy higher yielding currencies or are likely to reduce their positions in the higher yielding currencies. When economic conditions are uncertain, investors tend to put their investments in safe haven currencies, which tend to offer low interest rates like the US dollar and the Japanese yen. It's pretty simple to find a suitable pair to do a carry trade. Remember to look for two things. 1, find a high interest rate differential, and 2, find a pair that has been stable or in an uptrend as long as possible in favor of the higher yielding currency. Always remember that economic and political factors are changing the world daily. Interest rates and interest rate differentials between currencies may change as well, bringing popular carry trades out of favor with investors. So doing a carry trade, you should still limit your losses just like a regular directional trade. When properly applied, the carry trade can add significant income to your account, along with your directional trading strategies.